Bismillahirrahmanirrahim. Assalamualaikum and very good morning to all of you, especially Dr. Heli. Selamat Hari Raya, maaf zahir dan batin. So it's an honor for us today to deliver a presentation. So the topic that our group will cover is chapter number 2, an overview of financial system. So before we start, let me introduce our group members, which is the first presenter is me, Indra Wahyuni, second presenter Nabila, third presenter Muhammad Firdaus, fourth presenter Muhammad Nizar, and the last presenter is Nur Rozliani. Our objective with this presentation is at the end of these presentations, all of you should be able to understand and can describe what the function of financial market and financial intermediaries, structure of financial market instrument, financial intermediaries, and the last one is structure of Malaysia's financial system. So we hope you can give a fully attention to our group presentation. Thank you. Okay, so financial markets perform the function of channeling funds from people who have a surplus funds to people who have a shortage of funds. Okay, so those who save are the lender savers, or in economic we call it as a surplus unit, and those who must borrow are the borrower spender or deficit unit. The surplus unit are household, but business enterprise and the government as well as foreigners and their governments sometimes also find themselves with excess funds and so lend them out. The most important deficit units are businesses and government, but households and foreigners also borrow to finance their purchases too. Okay, so this is a flow of saving and investment in two-sector economy. So with this diagram, we can see that how there is a circular and continuous process that takes place between both sectors. Okay, so we go to the financial intermediation. Okay, so the definition of financial intermediation is a process where the governments, commercial banks, saving and loan associations, mutual saving banks, credit unions, insurance company, pension funds and mutual funds transfer funds from savers to investors. However, for financial disintermediations is a process where savers take funds out of a deposit account and invest directly in bonds and stocks. Okay, so next there's two segments of financial market, which is direct and indirect finance. Okay, so for the direct finance, funds are obtained by borrowers directly from lenders in financial market by selling them or the lenders securities or financial instruments which are claims on the borrower's future income or assets. So securities are assets for the persons who buys them, but liabilities, IOUs or debts for the individual or firm that sells or issues them. An example of direct finance is the issuance of common stocks and bonds. So these securities are first issued in primary markets and then resold in the secondary markets. Okay, so for indirect finance occurs as a result of financial intermediation. That is a process where governments, commercial banks, saving and loan association, mutual saving banks, credit unions, insurance company, pension funds, and mutual funds transfer funds from savers to the investor, which is the borrowers. Okay, so financial institutions act as intermediaries, channeling fund from savers or the lenders to investor, which is the borrowers. Financial intermediaries, indirect finance, are a far more important source of financing for corporation than securities markets, direct finance in many countries. Okay, now here is a closure of how financial market works. So there is indirect finance and direct finance. Now let's look at the direct finance first. Okay, if funds are transferred from lenders or saver to the borrowers through financial market, we will call it as direct finance. However, if the funds are transferred from lenders to the borrowers through financial intermediaries like banks or other financial institutions, that will be known as indirect finance. Hope you can understand. Thank you.
Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. To Professor Madya, Dr. Himatun Borhan and my friends. My name is Nabila binti Salihan. I would like to present about the structure of financial market. Financial market comprise 4 key components. Firstly is debt and equity market. Secondly, primary and secondary market. Thirdly is exchange and over the counter. And lastly is money and capital market. Firstly is debt and equity markets. There are 2 ways in which a firm or individual can raise funds in the financial markets. The most common method used is to issue a debt instrument such as a bond or mortgage. The maturity period is the date on which the debt instrument expires. The maturity period of the debt instrument is divided into 3. Short term if it matures in less than 1 year, long term if it matures in more than 10 years, and intermediate term if it matures between 1 to 10 years. The second way to raise funds is by issuing equity. Equity is the right of claim of an asset by a creditor. Honest equity is the total assets of a firm, bank or individual after deducting total liabilities. Often equities provide dividends to shareholders, and they are assumed to be long-term securities because they do not have a maturity date and pay dividends to their holders on a regular basis. Okay, secondly, the primary and secondary markets. A primary market is a financial market when a firm or government entity borrowing cash sells new issues of a security such as bond or stock to the first buyers. The secondary market is a financial market where previously issued securities can be resold. A well-functioning secondary market requires securities brokers and dealers. Brokers act as an intermediaries between buyers and sellers of securities. By purchasing and selling asset at set price, dealers will connect buyers and sellers. Next is exchange and over the counter. The second market can be conducted in 2 ways. First, through exchange, where sellers and buyers of securities meet in one location to conduct transactions, such as the Kuala Lumpur Stock Exchange (KLSE). The second way is through over the counter, where traders in different locations who have securities are willing to sell and buy securities over the counter to anyone who meets them and accept the price offered. Because traders communicate through computers, the over-the-counter market faces a lot of competition. Many stocks are traded through OTC. Lastly is money and capital markets. One way to differentiate a market is based on the maturity of the securities traded in that market. The money market handles short-term debt or loan transactions such as trade promissory notes, short-term credit notes, overnight money, and interbank loans. While the capital market involves long-term security transactions, usually with a maturity of 1 year or more, and which do not have a specific maturity. Generally, the money market is a short-term liquidity financial asset transaction, which usually has a maturity of less than 1 year, while the capital market is a long-term financial asset transaction with a maturity of more than 1 year or no maturity. Usually, money market tools are more liquid than capital market. In Malaysia, the capital market mainly consists of the government security markets, the stock market, and the corporate equity market. Money market securities are typically traded more widely than securities that have longer trading periods. It also has higher liquidity. Short-term securities have lower price drops than long-term securities, so they are a safer investment. Banks often use this market to obtain interest rates for their surplus funds. Okay, that's all. Thank you. Assalamualaikum.
Hai, Assalamualaikum dan salam sejahtera. My name is Muhammad Firdaus bin Azhar. So today I will present about the financial market instruments. So today, as we can see, the table shows that financial market consists of two, which is primary market and the secondary market. So the next slide is the financial instrument defined as a traded by both individual, household and firms, and by financial institutions in wide variety of financial market. It consists of two broad market, which is primary market and the secondary market. The issue of stock and bonds for the first time usually take place in the primary security market, which is known as IPO. Next is when the security are bought or sold after the initial offerings, they are being negotiated in the secondary markets. Example in Malaysia is known as KLSE and the KLOFFE. Capital markets is known as the transaction include trading of security with a maturity of 1 year or more. For example, is known as the stock market, mortgage market, corporate bonds market and the government security market. And then the money market. Money market consists of security issues in principle for 1 year or less. For example, bank acceptance, treasury bill, NCD, repurchase agreement and the commercial papers. So next slide, we look for the money market instrument. The first one is the non-government paper. Non-government paper have four types, which is bankers acceptance for the first one. So banker acceptance is the created in the course of carry out international trade, and it is pen draft issued by a firm. Next is repurchase agreement, it stands for REPOS. Repurchase agreement is an agreement made usually a bank to sell security to its customer, coupled with an agreement to repurchase them at a price that include accumulated interest. It is also known as an effective short-term loan. Next, the third one is the negotiable instrument of deposit. It is a debt instrument sold by bank to depositor that pays annual interest of a given amount. It is known as non-negotiable. The last one is the commercial paper known as CP. Commercial paper is a short-term debt instrument. It issued by a large bank and well-known corporation. Next, we look the second item of the money market instrument. It is known as government paper. Government paper consists of three items, which is Malaysian Government Security (MGS), Malaysian Government Treasury Bill (MGTB), and the last one is Cagamas Bond and Notes. As you can see, Malaysian Government Security (MGS) it consists of government bonds on loan stock, and then it issued on the tender basis from the Treasury via BNM. Then next, the second one is the Malaysian Government Treasury Bills. It is a short-term debt instrument, and then it is known as most liquid of the all money market instrument because they are the most actively traded. Next, last but not least, is the Cagamas Bond and Notes. Cagamas Bonds and Notes are established in 1986. It is to promote the secondary mortgage market in Malaysia. It issues four types of debt security to fund its mortgage purchase activities, such as fixed rate bonds, floating rate bonds, short-term discount notes, and the last one is Cagamas Mudarabah bonds. So after we look for the money market instrument, next we look for the capital market instrument. It consists of two, which is debt instrument and the equity instrument. So in a debt instrument, it has four instruments, which is the first one is a mortgage. Mortgage is a loan to household or firm. Next is corporate bonds. Corporate bonds is an intermediate to long-term debt obligation issued by companies. And then the third one is a convertible bonds. Convertible bonds is a convertible into stock at a specific price. Then the last one is a junk bonds. Junk bond is a corporate bond that possesses both high yields and high risk. So next we look for the equity instrument. Equity instrument consists of two, which is common stock and the preferred stock. Common stock is a share of ownership in a firm that carry out the right to vote, but in preferred stock it not entitled shareholder of voting right.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad Nizar bin Ahmad Nazri. I will be talking about financial intermediaries. We have learned before in previous sections. In a financial system, one of the purposes of a financial system is to transfer funds from surplus units to the deficit units, from lender to the borrowers, from depositors to businesses that need funds. The way that we transfer funds involves a number of processes. There are two main processes, which are indirect finance and direct finance. Direct finance is where funds are transferred directly to the borrowers, and indirect finance are where funds are transferred from borrowers through an intermediary called financial intermediaries to the borrowers. The financial intermediaries are typically banks, financial companies, and investment institutions or investments organizations. The four main functions of financial intermediaries. Number one is a saving function. It provides an outlet, it provides a method for publics to save their money and gain potentially profitable income, and provide a relatively low risk outlet. In terms of the second function, it's called the liquidity functions. It provides means for raising funds by converting financial assets into cash balances easily. The financial intermediaries would provide avenues for savers or depositors to convert financial assets into cash easily. And then financial intermediaries also helps the government in terms of policy function. The policy function can be defined as providing a channel for government policy to achieve the nation's goals. So a government wants to achieve a certain financial goal, such as high employment, low inflation, sustainable economic growth, and favorable international payments position, where financial intermediaries has the ability to provide an avenue for government to achieve this policy. The fourth function of financial intermediaries are wealth function. One of the reasons financial system exists is to provide people with an avenue to increase their wealth, to improve their well-being by increasing their wealth. So one of the ways is to provide a means for the public to store purchasing power to be used at a later future date to be spent on goods and services. So these are the four main functions of financial intermediaries. Next, we're going to look at the major structure of financial intermediaries. The structure of financial intermediaries can be categorized into three main categories or three main structures. The first one is the depository institutions, the second one is contractual saving institutions, and the third one is investment intermediaries. The first structure, depository institutions, these are the kind of institutions that accept deposit from people like us and also from institutions. And they also provide loans for individuals and institutions. These institutions are important because they are a very critical element of creating the money supply in the financial system. Example of these institutions include commercial banks, saving banks, etc. And then you also have contractual saving institutions. These institutions, they acquire funds from the public at periodic intervals on a contractual basis. For example of these contractual saving institutions are, for example, the EPF, the Provident Funds. So these institutions, for them, liquidity of the asset is not as critical or as important as for depository institutions. The main important focus for contractual saving institutions are long-term securities, so they do invest a lot in long-term securities. The third structure of financial intermediaries are investment intermediaries. So these involve mainly in wealth creation. So these institutions include financial companies that provide investment avenues and also mutual fund companies. So this company provide opportunity for public or the lenders to invest their money in institutions that would provide them return on a certain rate on a periodical basis. So those are the key elements or the key information on financial intermediaries.
Assalamualaikum, my name is Norzani binti Muhammad Rozis and I will present and explain about structure of Malaysian financial system. So for Malaysian financial system, we divide it into two, which is financial institution and financial market. As our previous presenter explained, the financial institution is institution that channel funds from the lender to borrowers and act as intermediaries, and the process of indirect financial intermediations. For financial market, it is channeling fund from people who have a surplus fund to people who have a shortage funds, and also called as financial disintermediations. For financial institution, we can divide it into two, which is banking institution and non-banking institutions or non-banking financial intermediaries. For banking institutions, we also call it as the monetary institutions, where only the commercial banks are regarded as the monetary institutions, and the principal liability of monetary institution is generally accepted as money. Next is the non-bank financial intermediaries, or also we call the non-monetary institution, which is other than the commercial banks are considered as the non-monetary institutions, and the principal liability of non-monetary institutions is generally accepted as near money. Under the banking institutions, we have Bank Negara Malaysia that act as the central bank of Malaysia. Then we have commercial banks, which is the largest group of financial institutions, and it is provide banking facilities, current account and the overdraft facilities, trade finance, working capital and investments fund, and it is also remittance and current account from the backbone of the payment system. For other non-bank financial intermediaries, we have a provident funds, which is the largest group for non-financial intermediaries. It also involves the long-term funds usually meant for long-term stable investment. APF is a larger within this group, and together with the teachers' provident funds, the armed force funds, the social security organizations, they make up the largest single holder of the public sector debt. And next is insurance and takaful, which is unlike the providence and pension funds, these are profit motivate private companies which offer their client coverage against risk for a fee, and they participate actively in the capital market. It is also hold the significant amount of asset in the form of deposits in the banking system. And next is development financial institutions, which is Malaysia Industrial Development Finance Berhad, or MIDF. It is the largest within this group, and their source of funds comes mainly from the government long-term loans, the commercial banks, and the provident of pension funds. Also have a saving institution that mobilize a significant amount of small saving, especially from lower fixed income groups and those in the rural areas. And besides BSN, including credit cooperations such as Bank Rakyat. For financial market, as our previous presenter have explained briefly, but for Malaysian financial system, we have a money market, foreign exchange market, capital market, and offshore market. That's all for financial markets in Malaysia financial system.